Today, this is where the S&P 500's PE ratio is sitting at, which should mean that over the next 10 years, the S&P 500's return will be roughly 0%. So today, something called the S&P 500 PE ratio is sitting at 22.5. This is a measure of how expensive the market is, and it's telling us the S&P 500 index is at one of the most expensive price points in history. So the Federal Reserve cutting interest rates is not just pushing retail investors into stocks, it's pushing them to buy stocks at one of the highest valuations in history, and that's a pretty dangerous cocktail. Unsurprisingly, buying stocks at lower valuations has yielded much higher returns looking out 10 years, and buying stocks at high valuations tends to lead to very low returns over the next 10 years. Today, this is where the S&P 500's PE ratio is sitting at, which should mean that over the next 10 years, the S&P 500's return will be roughly 0%. So looking at a long-term chart of the S&P 500 index, the rush of retail investors into stocks in 2025 is likely to be seen in hindsight as the worst possible timing for going into stocks for the next 10 years.